FAR.F4.M7.
So Jenna, I think leases are one of those topics that make people think, this can't possibly be this complicated. I'm just renting something.
And then they get to the FAR exam and realize accounting asks a completely different question. It doesn't ask whether you're renting something. It asks what economic rights and obligations you've created. That's the entire lens for this module.
I like that. Instead of asking, did I rent a building? The exam asks, what did this contract actually give me?
Exactly. This module is really about recognizing that a lease gives the lessee two things immediately. First, the right to use someone else's asset for a specified period. Second, the obligation to make payments for that right.
So the accounting mirrors those two facts.
Yes, you recognize a right-of-use asset, often called the ROU asset, and a lease liability. If you remember nothing else before diving into details, remember those two accounts arrive together.
That already feels less mysterious. The asset isn't the building itself. It's my right to use the building.
That's one of the biggest conceptual shifts students have to make.
Before we even measure anything, though, there's another question. Is this actually a lease?
Right. The textbook starts there. A lease is a contractual agreement where the lessor conveys the right to use real or personal property for a specified period, and the lessee agrees to provide consideration for that right.
So no identified asset, no control over using it, or no specified period, and you may not even be talking about lease accounting.
Correct. And another point the textbook emphasizes is that sometimes contracts contain both lease components and non-lease components.
That's like going to a hotel where you're paying for the room, daily cleaning, breakfast, and internet altogether.
That's actually a useful analogy. Part of what you're paying for is the right to use space. Other parts are services. The analogy isn't perfect because real contracts vary, but it helps explain why accountants sometimes have to determine whether lease and non-lease components should be combined or separated.
The exam loves asking whether everything belongs in one bucket.
Exactly.
Now comes what students usually fear: finance lease or operating lease.
Fortunately, the textbook gives a very structured approach. For a lessee, if any one of 5 criteria is met, the lease is classified as a finance lease.
Only one.
Only one.
Let's walk through them because these are extremely testable.
First, ownership transfers to the lessee by the end of the lease. Second, there's a purchase option that's reasonably certain to be exercised. Third, the present value of the minimum lease payments is at least 90% of the fair value of the leased asset. Fourth, the lease term covers at least 75% of the asset's economic life. Finally, the asset is so specialized that it won't have an expected alternative use to the lessor when the lease ends.
I always think of those first two as obvious ownership clues. If I end up owning it, or I'm almost certainly buying it, this starts looking much more like purchasing than renting.
That's a helpful way to organize your thinking. The remaining criteria focus on substance rather than legal ownership. If you're using almost all of an asset's life or paying nearly all of its value, economically it resembles ownership.
It's almost like the accounting is asking, even if you never technically own it, are you basically acting like the owner?
Exactly.
And here's the beautiful shortcut. One criterion. That's all it takes. If none apply,
then it's treated as an operating lease by the lessee.
Now here's where people often panic. Present value?
Fortunately, this module isn't trying to reteach all the mathematics. Module 3 already introduced present value concepts. Here, the focus is understanding why present value matters.
Because you're measuring today's obligation, not simply adding every payment you'll make over the next several years.
Exactly. The lease liability begins as the present value of the required lease payments using the appropriate discount rate.
The important word there is present. Future payments get translated into today's dollars.
Right.
Here's an analogy. Imagine someone promises to pay you $100 today versus $100 5 years from now. They're both $100, but everyone knows they aren't worth the same today.
That's precisely why present value exists. Money has time value. The lease liability reflects today's value of future obligations rather than their simple total.
The exam also likes asking about the discount rate.
Yes. Don't get so focused on memorizing numbers that you lose sight of what the discount rate is doing. It converts future payments into their present value. Whenever you see present value, immediately ask yourself what rate is being used.
Now we've measured the liability. What about the right-of-use asset?
The textbook explains that the lessee records both the lease liability and the right-of-use asset at lease commencement. Those two accounts become the foundation for everything that follows.
Then comes the part students mix up constantly: subsequent accounting.
Yes, finance leases and operating leases begin similarly. Both recognize an ROU asset and a lease liability. The differences appear after initial recognition.
Finance leases split the accounting into separate pieces.
Exactly. For a finance lease, the liability is reduced over time, interest expense is recognized using the effective interest method, and the right-of-use asset is amortized over the lease term.
So, instead of thinking I paid rent, I should think part of this payment reduced my debt. Part was interest. Meanwhile, separately, my asset is being amortized.
Perfect. That's the mental model.
Operating leases sound simpler.
They are. For an operating lease, the lessee still has a lease liability and an ROU asset. However, the income statement generally reflects a single lease expense recognized over the lease term instead of separately emphasizing amortization expense and interest expense.
That's probably the biggest distinction students need to remember. Same starting point, different expense pattern afterward.
Exactly. Many students incorrectly think operating leases stay completely off the balance sheet. This textbook makes clear that isn't the approach. Both classifications recognize assets and liabilities. The difference is primarily how expense recognition works afterward.
That's one of those places where old memories from older accounting rules can actually hurt you.
Very true. Always answer according to the framework you're studying.
Let's pause on another area that causes confusion: short-term leases.
The textbook explains that lessees may elect an accounting policy not to recognize right-of-use assets and lease liabilities for lease terms of 12 months or less.
So, not every lease automatically creates those balance sheet accounts.
Correct. Whenever you see a very short lease, your brain should immediately ask whether the short-term lease election applies.
Notice how that's an exception. The exam loves exceptions.
It certainly does.
Now, here's another analogy. Imagine borrowing a library book. You don't own it. You get temporary control. Eventually you return it. That feels similar to leasing.
It's useful because it separates ownership from use. Where the analogy breaks down is that lease accounting also measures significant financial obligations and recognizes them on the balance sheet. A library checkout doesn't normally involve a measurable long-term liability.
Fair point. So keep the analogy only for understanding the idea of obtaining usage rights.
Exactly.
Students also get overwhelmed because there seem to be so many moving parts. Lease payments, present value, ROU asset, liability, interest, amortization, classification.
That's why building a mental map matters. Instead of memorizing isolated rules, think about the sequence. First, determine whether you have a lease. Second, determine whether lease and non-lease components need attention. Third, classify the lease. Fourth, measure the liability and ROU asset. Finally, apply the correct subsequent accounting depending on the classification.
That's much easier than trying to memorize 20 disconnected facts.
Exactly.
Let's talk about disclosures for a minute. Students sometimes ignore disclosure requirements because they sound less exciting.
But they're tested. The textbook requires qualitative and quantitative disclosures regarding leases. Whenever you see disclosure questions, remember they're trying to help financial statement users understand the nature and effects of leasing arrangements.
So, disclosures answer questions that numbers alone don't.
Right. Numbers tell you what exists. Disclosures explain what those numbers represent.
Let's do a rapid-fire review. I say something. You react.
Go ahead.
Ownership transfers automatically.
Finance lease criterion.
Purchase option that's reasonably certain to be exercised.
Finance lease criterion.
Lease term equals at least 75% of the asset's economic life.
Finance lease criterion.
Present value of lease payments equals at least 90% of fair value.
Finance lease criterion.
Highly specialized asset with no expected alternative use.
Finance lease criterion.
None of those apply.
Operating lease.
Finance lease after commencement.
Interest expense plus amortization.
Operating lease after commencement.
Generally a single lease expense.
Lease term of 12 months or less.
Think about the short-term lease selection.
Perfect.
Now let's tie everything together. Many FAR topics feel like collections of rules. Leases actually tell one consistent story. The contract gives you the right to use an asset. That right becomes an asset. The promise to pay becomes a liability. Classification determines how those accounts evolve over time.
I like that because it's driven by economics rather than bookkeeping. The accounting follows what's really happening.
Exactly. Once you understand that idea, the individual rules become much easier to organize. Instead of memorizing isolated journal entries, you're explaining the economic relationship between the lessee and the lessor.
And that's probably the biggest takeaway from today's episode. Whenever a lease question appears, don't immediately start calculating. Ask yourself what story the contract is telling. What rights exist? What obligations exist? How should this lease be classified? Everything else grows naturally from those answers.
That's the mindset the FAR exam rewards. Understand the framework first. The calculations become much less intimidating because you already know where every number belongs.
And if you leave this episode remembering just 4 ideas, make them these. Every lease starts with understanding the contract. Every lease classification starts with the 5 finance lease criteria. Every lease begins with recognizing a right-of-use asset and a lease liability, unless the short-term election applies. And after that, always ask whether you're following finance lease accounting or operating lease accounting.
Once those 4 ideas become automatic, the rest of the module has somewhere logical to fit. That's when lease accounting stops feeling like memorization and starts feeling like a system.